Hello and welcome to the Week in Markets from True Potential. It's Friday the 5th of April, back after the long Easter weekend. Certainly it's been an eventful week for the data that's been coming out in markets thick and fast, as is usual over the first week of a new month. I'm joined by George Bell here today to help us navigate through all of this data, but maybe actually to cut through it and bring to life just those couple of key points that you were taking from it, George. What were the points that you found most interesting out of all of the data this week?
Probably a couple of areas. The survey data across both manufacturing and service sectors in the United States and also in China were quite important points. The other aspect was the labour data, which we've had from the US. We've just had another update there this afternoon, which has given a surprise to the reading. And
let's maybe start at the start of the week. So it was very much about the manufacturing data from the US and also from China. What were you taking from those?
Well, from both regions, an encouraging signal, and that's the manufacturing reading has moved from a detraction to an expansive reading. What we mean by this is we have surveys which look at a range of different businesses across the manufacturing sector, speaking to the managers within those businesses to get a sense of their order books, to get a sense in terms of their prices paid for components, demand for workers and so on. And what we've seen is a real improvement there, so a real shift in the dynamic.
And I suppose within that survey there was many interesting elements, but one that maybe jumped out a little bit was the prices paid element, as you alluded to there, just moving up quite materially over the course of the month.
It has, certainly within the manufacturing sector, prices paid has shifted up. Manufacturing in the US only actually accounts for around a third of the total value of the economy. 2/3 is actually driven from the service side, where the service sector has been in an expansive phase for a longer period of time, and the readings which we had this week just reaffirmed that we're still seeing expansion in the service, but there's still a couple of areas which are moderating at the margin.
And therein, I suppose, is the contrast or the difficulty for markets in interpreting data at the moment, that in one US survey for manufacturing, prices increasing, the contrast being in the services where we're seeing prices actually decline.
Exactly, and that could be quite an encouraging signal if it turns into a trend in terms of prices continuing to moderate, just given the service component has had quite a sticky impact in the inflation readings, in the sense it has been one of the areas which has been more challenging for the Federal Reserve to bring down the pressures which are helping us get towards the target.
We'll come on to talk about employment, but we did have quite a bit of employment data this week, and indeed it did surprise to an extent in terms of the strength of the wages, in terms of particularly one reading that we looked at when we were seeing those that were moving jobs, their prices their wages were increasing some 10%. So that's an important point for us just to bring out a data point earlier in the week. The other PMI data that you were mentioning there, George, was for China. And China has been sort of one of those enigmas for markets over the last number of, 18 months probably, since post-COVID. And just what were we seeing there in terms of the data?
You're seeing multiple dynamics. You're seeing an improvement in terms of factory output, exports. You're seeing a big shift in terms of demand for iron ore. You're seeing retail sales which are improving. So this is quite constructive for an economy which has been slowing in terms of the rate of growth, and we've seen the effects of some of this shift come through in the oil market as an example. So oil markets are up around 18% through the course of this year. This is another example of what we're seeing in terms of that shift and that bottoming out and improvement.
And I suppose it's speaking to that improvement in demand, that demand from China in terms of its daily oil consumption, but maybe also linking it back to your earlier points around the prices paid for the manufacturing sector in the US, just seeing that increased oil price feeding into manufacturing costs and working its way through.
Yeah, absolutely.
Maybe then bringing ourselves to today's main event, which was certainly the non-farm payrolls, that first Friday of the month. The data. What did we get from there, given that survey data in the context of it?
A surprise. We saw a reading of payrolls, so new jobs created and filled came in around 100,000 higher than was expected. So 303,000 jobs were added through the month, and the expectation was around 200,000. So there's quite a material
big difference
in terms of that expectation. And
it shows the challenge of trying to forecast these data points, doesn't it?
Exactly. And even January and February, they went back and looked at the prints for those months.
And were they revised up or down this time?
Revised higher.
Revised higher again.
22,000 in aggregate. So, lo and behold, it was higher, but by quite a way. And we saw a similar dynamic with another report series earlier in the week, which is the ADP report, which was showing, again, an improvement in terms of the demand for workers.
And I suppose therein is why the US economy is proving resilient, that the economy's got growth, but we're seeing ongoing positive growth in the labour force, and I suppose in the unemployment rate came in at 3.8% again, didn't it? And
if we look at the Federal Reserve's own projections, they, over the near term and the longer term, sit in a range of around 3.9 to 4.1%, so a fairly tight range. And if we look at employment conditions relative to history, they're in a pretty robust place.
They're in a very robust place, and I think what also I was taking away from that data today was just that small tick up again in the participation rate, so more people joining the labour force, which is a clear positive, and also hours worked marginally increasing as well. All things that would suggest that the economy is continuing to just move along quite nicely at this point in time.
I would say so. It's supportive for economic growth, but it's a challenge for the Federal Reserve.
Yeah, and I think that sort of neatly brings together a number of the points that we've been talking about here. The data gives us mixed messages. Certainly the strength is there today in the jobs number. We've also heard from quite a number of Fed governors in the US over the course of the week, and they've certainly been intimating that interest rate cuts maybe aren't as required as to the same extent as the market's been pricing.
Exactly. Powell was very clear that they've set a projection in terms of the level of interest rates and potentially even the timing in terms of when interest rate cuts could start to come through. So the expectation is for 3 in the course of this calendar year. But what they've been trying just to manage is the timing and reiterating the fact that it's going to be very dependent on the data, which is going to drive the view. So we've had a number of Federal Reserve speakers through the course of the week, and quite a mixed bag. It's
been fascinating just watching and listening to some of their speeches. You've got those that are there still thinking 3 cuts are fine. You've got others are now, well, it might be 1 or it might be 0, because they're more convinced on the strength of the underlying growth profile of the economy.
And perhaps some of that was in advance of, anticipating the fact that the jobs report today may have been stronger than expected.
And probably speaks to that fact as well, that they're now data dependent, as Powell has sort of reiterated over the course of the past week. They'll move from meeting to meeting. But George, thanks for that. That's been great to bring all of those key points that we're taking away from all of the data that's come out over the course of this week. And please do join us next week for Morning Markets, where we'll review the data as it comes.